Welcome to the Dividend Talk podcast, episode 164, Air Liquide Business Breakdown. Hey everyone, welcome to the Dividend Talk podcast, where we talk all things dividends with a European flavour. In this episode, we talk about a European powerhouse called Air Liquide. Air Liquide is a company that has a strong dividend history and distributes gases all over the world. Along with that, we also give some news of the week, we talk about some recent dividend hikes, and we answer questions from the community. Finally, before I go, I would like to announce that we are releasing our newsletter this week, where I personally do a deep dive into British American tobacco, and European DJ outlines how he assigns dividend safety scores. So please check out the link in the description, and we will see you on the inside. Hey, European DJ, how are you, buddy?
I'm doing very well. It's Sunday morning, but honestly, tell me how you are because you sound a little bit like you have a rough voice.
Yeah, usually when you hear me like this, it's tales of a hangover and I've had a great night. Unfortunately, that's not the case. I'm a little bit bunged up and my throat's a little bit sore, so I'm going to try and keep my talking to a minimum. The bad news for you is you'll probably have to keep the show ticking over first. But look, I'm still excited to do the show. I know we picked this company based on some suggestions we threw out. We're asking the community for suggestions, and this one came out. It piqued our interest as well because I honestly don't recall either of us talking about this business a lot. Sometimes it pops up as it's a quality business, it's a good European business, but I have to say before this I did not know a whole lot about them. So it was actually nice to see a little bit behind the company and see if it actually lives up to the hype. So I'm excited for this.
Yeah, and it's really in the top also of the Noble 30 index. So it's really one of the iconic European companies. And so maybe also for our listeners, sometimes we put on Spotify on the podcast some questions or a poll. So we asked in the last podcast which business breakdown people would like to see next, and Jorge answered Air Liquide, and that was really what triggered the topic of this show. But switching to the news of the week, have you heard anything about Apple's event from last Monday? I believe it was a Monday.
Yeah, I've seen lots of videos and memes and tweets where they basically copied iPhone 14 and put in a USB-C charging point, which we all knew was happening because there was an order for them to do that. But other than that, I didn't pay too much close attention to the whole event itself.
Yeah, but for me, that's also the highlight of the whole event. That's the USB-C port I believe they go to instead of the Lightning technology. But honestly, I think it's really, really good because if I just look around me now at my desk, there are so many different cables, and half of them are just due to different standards. Yeah. So the fact that Apple will also move to this one makes it so much easier. I can start borrowing, for instance, the cable from my wife and my son. Yeah, and we don't need to all the time switch cables in the sockets. But I also think like the waste of cables that everyone probably has at their home, I hope it reduces a little bit. I mean, this is just a USB telephone cable, but there's still so much opportunity. The issue here is, of course, is like technology innovation, because it will be much harder to start adopting a new standards, and probably the government will have to need to have a say in it. And if the government is in the lead of innovation, we know where that leads to. Yeah, that's more like Russian technology and such. When we look at some of those, let's say Russian cars. So that's an issue, right? And we have seen how advanced Apple is in its own innovation with their M1 chip and everything. I mean, those are really, really pieces of gold almost. So that is a bit of a disappointment, but to fight the cable waste, I think is really, really a good idea.
Yeah, it makes sense to have standard. But I agree with you. If the government are now going to control all of this, when will there be innovation, or how will there be innovation? So, but certainly, I'm looking down beside me, and I have a drawer here full. Must be 200 cables in there. Eventually, I can throw all them out. I don't need them. I don't need them anymore.
Nice, nice.
One interesting piece I saw this week was around Mercedes-Benz, and I know we get asked about car companies all the time, and we invest in car companies, and I think you're similar to me in that we normally avoid them, because honestly, there's always bad news around these companies.
Yeah,
And Mercedes popped up again because now they have to recall lots of their cars with this defect device that they built into them. This is obviously going to cost them billions to recall them.
yeah,
And obviously damage to the reputation. I mean, Mercedes-Benz is a big brand. People that typically buy them have money. They come from affluent backgrounds, or they have the money to buy them. So it's not a nice thing, but it's just something that stood out to me, because it's always like car companies. And Mercedes-Benz, I think we spoke about them, their dividend history is actually enticing. But then you see something like this and you're like, I hate car
yeah.
companies for this reason.
Exactly, and they are not, car companies can't be trusted when it comes to their dividend, because it's either a recession that might kill their earnings or whatever. And when I think about Mercedes and the German car manufacturers in specific, I just wonder how they will be able to compete with China's EV production and Tesla. I know BMW and such are all also heavily investing in EV, but can they do it at the same cost level?
Yeah.
I mean, I really feel like the German car manufacturers are a little bit late in the game with everything. And of course, they can still rest on their brand appeal for now, but I really don't know if it's sustainable. I really don't know.
No,
I'm staying away generally from the whole car industry, also no Tesla and such. But yeah, very interesting to see how this evolves.
Yeah. Okay. Some dividend hikes this week. We don't have too many to talk about. Philip Morris had a low 2.4% dividend increase to their quarterly dividend, which brings it up to 130. And then Verizon, which we talk about, had a 1.9% increase. And I don't think I'm surprised by either of the two of them. Verizon is almost like a bond at this stage, high yielding. You're kind of expecting 1 or 2% growth. And Philip Morris, I probably would have expected a little bit higher from them in lines if you look at British American tobacco and stuff. But to be fair, they're trending towards 3-4%. So if you look at that, they're not too far off that either. So I won't be too disappointed.
And of course, the payout ratio is much higher for Philip Morris as well.
Yeah.
So no, I think high yield, low growth, and they fit like that in certain people's portfolio. I would say I don't own any of them. I have been looking at Verizon in the past, but if I also see what happened to AT&T. Yeah, no, not my circle of competence, let's say. And
the balance sheet scares me. It really does.
Yeah, exactly. Too much debt. But it's not like I'm afraid of debt in itself, but I don't see that they have a strong. I said they are the ones that are investing for others. Yeah, others benefit from their capex.
Yeah.
So.
Okay, so that brings us up to the main topic today, which is all about Air Liquide. Ticker symbol, for those that don't know, is AI.PA, so on the Paris Stock Exchange. And I'd have to say, just before we start talking about this, I really struggled to, with some companies, you can instantly grasp what they do, how they make money. You can read their annual reports, you can read their website. And within 10, 15 minutes, you have not a deep understanding, but you have an understanding of how they make the money, where they make the money, and generally what their values are. I got distracted, open up their annual report. It's just too many visuals. I found it hard to focus on what they do and actually deeply understand what they're about. I don't know if you had the same experience. But
I had exactly the same. And I went, for instance, to the presentation of their Capital Markets Day, and they are laying out their strategy, and then they are talking about the opportunities, and they say this market will grow, and then they just don't mention how they are going to support that with their products. Yeah. It's really annoying. Yeah, you need to use other sources really to figure out what they are actually doing in the market. For instance, healthcare, they mention nothing there. and then I need to really start searching about what healthcare effectively is doing for them and how they contribute to the healthcare industry. They talk about home care. Yeah, home care what?
Yeah.
Yeah, it suggests when you are like a newbie, it suggests that they are employ that they are producing drugs or devices, medtech devices or something like that. And of course, it's a gas company, and once you know it, yeah, you understand. Okay, they're providing like oxygen for patients at home that need it, right? But it suggests they are all, well, it actually suggests nothing in their capital markets day. So it assumes that everyone understands the business already, but they don't have a good explanation of their business anywhere on their websites and such, and not to that level that you understand what they are doing in each market. And for me, it sounds like they spend too much money on visuals, on consultants to create this for them. But for investors that are interested to get introduced to the company, the only thing they really mention is the dividend here as what is enticing to it, and a bit of their history. For me, I just think they, when I read this, they lost reality with who investors are, who new investors are. They don't understand it because, yeah, like you say, this one took twice, 3 times more mental effort to actually understand, and
Yeah.
that's annoying.
Yeah.
And I when I see this, I want to see Warren Buffett's website with Berkshire Hathaway, like straight to the point.
Exactly. If we were not doing this for a podcast, honestly, I would have give up after 10 minutes because
Yeah, I
it
would
was
have
just
switched.
it was just too hard. But knowing what we know and some of the research we have done, can you give a little bit of an overview? What does the company do? How do they actually
Yeah.
make money?
So I think what's for the listeners just important to know that their name says it all. Yeah, it's a multinational industrial gas company. It's from France, so it also means from the dividend tax point of view here, if you have your broker being able to claim the dividends for you, you should be able to get a 12.8% dividend withholding tax rate, and otherwise it's probably 30%. It's with Linde and such, the competitors. It's one of the world's largest suppliers of industrial gases. Now you need to think here about, for instance, oxygen, nitrogen, hydrogen, and then other gases like along these lines that are really used a lot in the industry. Yeah. The company has been founded in 1902, so it's already existing for 121 years, which is really, really long, and it's been really a part of, let's say, the industrial revolution that we've seen over the last 100 years. Now, if you then think about their core businesses, right, it's really around producing, storing, and distributing those industrial gases. They are used in, for instance, welding, in cutting, in the healthcare, like I mentioned already, home care as well. But think about just the liquid gas that are being used in hospitals, the oxygen that patients get, respiratory devices, also home devices. So it's really used a lot in these kinds of application. But also, when you think about electronics, food processing, it's almost everywhere. We just don't see it. You see it sometimes when you're driving across the highway. You might see their tanks and such in the landscape, specifically near the factories and the larger industrial complexes. They have a global presence. They are operating in around 80 countries worldwide, most significantly in North America, Europe, and Asia Pacific. And they have a lot of distribution center, network, and production facilities. And of course, as a business as well, they have some R&D labs as well. Now, if you look then at their product portfolio, right? So I just mentioned already some industrial gases, healthcare gases, but for instance, the I hate this word, hydrogen energy, like production, storage, and distribution for clean energy applications. Yeah. So what is also interesting here, we have got, of course, the climate change going on and the Paris Agreement. And so there's also naturally a lot of focus on sustainability for them. But this is also, I think, if we start to look at the bull cases, where also one of their, I think, bull cases is because many companies have committed to, for instance, CO2 reduction and such. And we often spoke about Shell as
Yeah.
being big in liquid natural gas. Um, this is also a play on your clean energy, because when companies want to move away from dirty fuels, I think Air Liquide is really a company that can offer solutions here, and they have it also in their strategy, right? So after 2030, they really want to start tackling the maritime business. So those all dark brown coal tankers, let's say, shipping through the Suez Canal towards Europe, but also the aviation industry. So that's still far away because it's really complex to get there. So short term, they are more focused on, for instance, hydrogen trucks and such, right?
Yeah.
Really to support the on land infrastructure.
Yeah, it's quite interesting, as you said. Like, generally, anywhere there's a gas, these guys are involved in. But you're quite right when you talk about the Paris Agreement and climate change and low carbon, because as soon as you open up their annual report, it must be 70, 80 pages of nearly all about that. They're talking about that quite a bit. And what that has led them into partnerships and agreements with companies such as Shell, where they are looking to, I believe in Italy, they have some solar energy capacity. So they are looking at this renewable energy space as kind of a gateway into that. Total Energies is another one. They have an agreement with to produce renewable and low carbon hydrogen. So you can see that it's opening up opportunities to merge. I know they're competitors with some of these, but they're actually merging, and companies are helping each other break into this. But it's I think it's definitely one of the bull cases is this low carbon, low emissions, and renewable energy that they're transitioning into. So it's quite interesting to see that.
Yeah, and if you also look at their breakdown, right? So they're in the business of gas and services, engineering and construction, and what they call global markets and technologies. But for instance, the first half year of 2023, they earned 13.4 billion in gas and services on a total of 13.9 billion in total revenue. So this is really their core business, and the rest is just like I don't know,
Fun money.
pocket change. Yeah. If you then look at how they earn their money across the geographies, so and I'm talking here about the first half report, right? So if you want to have the annual, you kind of need to double it probably. But the Americas is generating the most, 5.1 billion, and then Europe is 4.9 billion. So they're really the main two areas where they are operating. And it's interesting that the French company actually still earns the most from the Americas. And then Asia Pacific is around 2.8 billion, and the Middle East and Africa is like 500 million. It doesn't surprise me, the Middle East and Africa, they're in the desert. They have a lot of other companies as well, and also a lot of protectionist policies. So I'm not surprised that in the Middle East, there's not a lot of business for them. On the other end, if you then zoom in a little bit from the gas and services revenue into the different classifications that they use. So they have large industries, industrial merchant, healthcare, and electronics. Now, large industries, that's really interesting. In the first half year, they declined 18% from 4.9 billion to 4 billion. That's really, really a big decline. But in January, the industrial merchant, they grew from 5.5 billion to 6 billion. Healthcare grew from 1.9 billion to 2 billion, and electronics from 1.2 billion, kind of flattish. So really, the large industries decline was mainly caught up by the industrial merchant business unit, and it's really interesting, right, to see that actually compared to last year, the business has been declining year over year in the first half year. And this is also a narrative that I want to pick up later on a little bit, because of course the share price has been doing really well over the years and driving, I would say, most of the total return that shareholders have been experiencing.
Yeah, but I think the first half, because I have the 2022 annual report open. I know you're looking more at the half year report, but I think they're coming from a high base when you compare that, because the growth in these in large industries was 50% year over year from 2021 to 2022. So you can imagine last year we saw a lot of growth in that. So it's probably stabilizing a little bit and seeing some of that drop off.
Yeah, makes totally sense. Makes totally sense. So, let's move from here a little bit to the strategy then, right? So, because we know now a little bit like short-term performing and how they were doing, how they are split up, how they report their segments and such. We understand a little bit what they are in. So, but what's their strategy really, right? So, if you look at their strategy, they're really looking at 4 elements here. So they want to really double down on the innovative air gas solutions, and for instance, renewable electricity is a part of it, ultra low energy, oxy-combustion. They are really focused on lowering decarbonization. Yeah, so they're thinking about they're looking actually into carbon capture, and they have some a few projects already on the go in Northern Europe. They're looking at liquefaction of that. They're also looking at electrolysis. I really don't understand really well what this is about, but they're partnering here with Siemens Energy. And of course, they are also looking more at the digitalization of their business, let's say. Now, if you look at what this translate into direct, let's say, areas of industries that they are focusing on, they're focusing, for instance, and I mentioned already a little bit on mobility. So they are currently developing a complete ecosystem for hydrogen trucks. And yeah, we can imagine switching trucks from diesel to hydrogen is a big change, right? And I know that specifically in North America, they're really, really interested in this. And I also know that Shell was in the past really partnering in this, for instance, in Canada, right? Here. Now, and what I also found really interesting is the electronics industry, because we know that the chip industry is currently, for instance, investing many, many billions. And I think the whole electronics industry is investing currently 700 billion into new manufacturing plants, as an example, and new machines. But these all need new energy efficient on-site gas generators to keep the cost in control. So if you're bullish on the on the chip industry, also Air Liquide here is an essential partner for those companies to keep the energy costs down. We spoke already a bit about healthcare, right? Medical oxygen, nitrogen, respiratory therapy, and then what we mentioned about home healthcare, for instance, the home oxygen concentrators. Industrial merchants here, support for instance, battery factories. It's a little bit like what we just mentioned to electronics as well. And what I also like is that they, not to a large extent, but they are also really keeping an eye on the space industry. Yeah, and what they're doing with satellites there, oxygen as well. I guess for the rockets that we're sending into space and such. So they're really having a few nice target industries that are really booming, that they can benefit from by having the right solutions there. So for me, their strategy actually is really solid. But yeah, you need to really dive deep and really think twice what they are mentioning in their results. And I will keep repeating that it's really hard to read. And I want, if anyone from Air Liquide, from Investor Relations is listening here, guys, spend some time on simplifying this. But these are some of the 5 bull cases that they're investing in, while of course not forgetting their main business here. Yeah. So for me, if they're able to realize this, there's still a lot of growth ahead for this company.
Yeah, and maybe then we should look at their financials a little bit and look at their income statement. We talked about growth. How have they been growing over the last 10 years?
Yeah, so if you look at their revenue, like over more like 20 years, it's on average 6.5%. Their EPS is in line with this, around 6.8%. So what it tells us is that this is not a SaaS business where you have one-off costs and then you don't have any. So you have one-off fixed costs, but your incremental costs are limited. No, here this is pretty much in line. So it is a cash-intensive business, so to say, and revenue is not easily. Additional revenue is not easily translating in multiple additional EPS. So it means like really it's hard to scale such a business. And that's of course normal. If you need all these facilities in there, these products in there, it's not easy to scale this. Yeah. lots of work involved. Cash flow wise, they have been growing around 7.2%. So this is good to see. I always like the cash flow to be a little bit higher than the EPS and the growth rates, because that means that they are translating and trickling it down more and more cash efficient with this. And the dividend per share has been growing 8.4% over the last 2 decades. If we go a little bit to the last 5 years, though, I find it a little bit more disappointing. So in 2018, they had the earnings per share of €4.5, and now in 2022 they had 5.28 earnings per share. So there's not a lot of growth, over the last 5 years. Dividend per share either, from €2.4 to 2.95 at the moment. They just had a 5-cent decrease in the last year, which is, what is it, 2%? Not even. So that's really disappointing when you look at a business like Air Liquide, right, which has so much potential, specifically in the transition that we are in now. Payout ratio is kind of flattish, around 55 to 60%. On general, the dividend yield over the last 5 years has been around 2%. And this is what I don't understand, because relatively speaking, the business is slow growing. Slower than what their forecast suggests when you look at all the opportunities that they have. So why is the stock market rewarding the company only with a 2% yield, let's say, if the company is also paying out already 60% almost of their earnings? Usually you would expect a 3% or more yield right now. So that's a question that maybe might be clarified later on still by looking at the balance sheet and such. But generally speaking, I would expect such a company to trade lower at higher yields.
Yeah. And speaking of the balance sheet, then what do you think of that? I mean, we can look at our dividend safety after that. But to me, initially, the balance sheet is actually quite strong to me.
Yeah, the balance sheet is really solid. So if you look at, for instance, their equity or debt to equity, I mean, it's standing at half, I believe. So I think it's 56%, right? And what is also really nice is that their free cash flow is much higher than their dividend payments, right? So they've been able to buy back a few shares, but they have just cash left. If you pay 60% out, I think like 35% goes back, and they've been mainly paying down debt with that, because in 2019 their debt was still around 12.7 billion, and it's now slightly below 10 billion. So they've been nicely paying down debt. With that, they also reduced the interest payments, of course. So they have a really strong balance sheet, and I believe they have a credit rating of A2, an interest coverage of almost 12. So from my point of view, the balance sheet is really strong, and this is why I think also companies are rewarding this. The stock market is rewarding this company a bit better. Probably the growth prospects, they are buying into their strategy here, plus a strong balance sheet, which allows them also still to invest in the business, to do some acquisitions. So generally speaking, I think the quality lies more in the balance sheet that we see here. And if you then take the story on top of it, probably the stock market wants to put this company at a higher share price and a higher multiple. Personally, I want to see more of this, because the Paris Climate Agreement is already existing for a long time. They have not been able to translate it in the last 5-6 years into growth numbers really that excite us. So for me, the company, therefore, I think is already based on that, trading at a multiple that I find not justified compared to where the company should be.
Yeah, but hey, we're dividend investors, so what think of the dividend then? Is it safe? Can they keep growing it if they're growing so slowly into the future? What are your thoughts on their dividend?
I have no doubt that the dividend is safe. Look, they have been growing the dividend for 48 years. They give an annual payout ratio. The last 5 years, the dividend CAGR was, let's say, around 4%. Also, the dividend policy is just really progressive. So how we sum it up is typically they grow the dividends when earnings permit, but they have been doing this for 48 years. Generally, I believe they want to keep the dividend payout ratio around 50%, and that's why we have seen a slow dividend growth, specifically over the last year, because their earnings were not growing to that extent, and they also knew that their earnings will not be so strong going forward. So the dividend safety profile for me is around a dividend safety score of 70 for people that follow us a little bit on the other content streams as well, which is for me a safe dividend. It's not very safe that you say like, wow, this is like rock solid safe. No, it's just safe. If things go wrong here, there is a bit of cushion via their balance sheet. So I think it's a fair safety rating that we're giving it here. But they really need to turn back to growth because their free cash flow and their EPS has been growing a disappointing way, I would say, and that also keeps the dividend safety score lower.
Yeah. Okay, so overall, then, to summarize, it is a solid business. It has a good business case. As you said, it's a company where you don't necessarily see it all around you, but it is probably everywhere. A strong balance sheet, growth prospects can be a little bit better, and a safe dividend. So overall, it's a decent company.
Yeah. So the question is, would you like to own it at these prices?
For me, based on the growth prospects that we're talking about and the slow growth, and the low dividend yield as well, it's probably outside of my fair value range. I haven't done a DCF on this, to be fair.
Yeah.
But just from what we know, it probably would seem a little bit too expensive for me. I would prefer the yield here to be above 3%, and then I would probably look at it in terms of share price.
It's for me the same because the yield is now around 1.8%, and the price to earnings multiple is 28. So for me, this company will be attractive around the multiple of 20. And then I already find it on the high end because of their recent performance over the last 5 years, let's say. They don't give me a lot of hope that their strategy into those new industries, well, not new industries to them, but that their strategy will really lead to, for instance, high single-digit earnings growth. Yeah, I don't see it because I believe they should have been able to execute on that already. I know they have some long-term investments at play there, but seeing is believing. So for me, I start to be interested at a multiple of 20, and then we're really talking about a share price in the low hundreds. And at the moment, it's trading 168 euros. So I need to see a deduction of 60 euros at least. And to your point, it will be yielding then around 3%. And yeah, that's when I start to be interested. So for me, the company is heavily overvalued from that point of view. And yeah, but it's really interesting to do a bit of a business breakdown on this one, because what we always say, right? It's not about only looking at companies when everyone talks about it in the media. I think now is the time to study it. We have a clear mind. We have a more objective view. It's not driven by others, influenced by social media, not influenced by the news. So we can look at it, I think, more objectively at it. And from that point of view, yeah, I now know when I will be interested in this company. So I will mark it somewhere in my notes around 100 euro. And until then, I just don't need to look at it further. And when it starts coming into that zone, I will be doing a further double check and then maybe initiate a position, because such a European powerhouse, it is a high quality business with a strong balance sheet. I would say such a European powerhouse deserves a spot in my portfolio in generally.
Very good. So we'll move on to some listeners' questions now, and I will start with Thomas's question. It's quite a long question, but I'll give you a summary of the question. And he's asking, do you take into consideration the credit metrics of the country when you're investing in some of the companies? So, for example, the credit score, debt to GDP, etc., etc.
No, not at all. But I do have my opinion about certain countries. So, for instance, I find it much easier to invest in stocks that are trading in, for instance, the Netherlands or such, because of the tax, dividend tax, of course, but also because I see the economy more open to investments and global trade. But if I then think about investing in Poland, here where I live, I'm a bit more conservative from that point of view because of the dynamics of the markets. Now, it means like this is a growing country, so that there are also opportunities. but there's also higher risk associated to it, because it's also very much depending on export and foreign investments. So I don't know how that would look like in a global slowdown. The last time it happened in 2008, it was actually a reason for many companies to nearshore here. But will this happen still if it happens again or not? The currency risk related to it, the safety risk, also when you think about what's happening in Russia. So I do have my opinion about certain companies, which I think are more in line with what a credit rating of a country would suggest.
Yeah. I don't actively go out and look at this, but I think by default, and I'm trying to think off the top of my head, most of my companies have their main portion of their business in America. And then even the European companies, America is probably their biggest market. One that came to mind was Orange, that I did hold as a yield play, and then they rose in price to a share price that I sold them at. Because that was pretty much a yield play, and when they went past the share price, I sold them. But they were the closest, because their biggest market was in France. But generally, no, I don't think about it, because America is probably still my top dog.
Yeah, nice.
Kevin has asked us, with bonds now becoming available on Trade Republic, do you think there's a place for the income investor to have bonds in their portfolio?
Yeah, and he also mentions if corporate bonds would be interesting for companies with decent credit ratings. I mean, I'm personally not interested in bonds, but I definitely feel it has a space in people's portfolio. The question is, what do you use it for? I think if you use it for capital protection, I think it has a space there, but don't be misled. Also, we see high fluctuations in bond values based on interest rate fluctuations. So it's not a given that your capital is protected. But if you're interested in income and growing income, then that's where it doesn't interest me, because I can get similar yields in high quality businesses, right? And whether it's low yield or high yield, there are also some attractive high yielders out there with a safe dividend profile. So that's why I'm not interested in bonds, because I'm not interested at the moment in capital preservation for when there would be a rainy day. I'm not at that cycle in life yet that I look at it like that.
Yeah, but of course it does have a place in most income investors' portfolio, particularly if you're looking to preserve that capital,
Exactly,
and have a bit of safety around that. And look, we talk about diversification, but I think in the beginning there was lots of talk of diversification in terms of stocks and bonds were included in that, and have was a 70-30 depending on your age profile. So look, it all comes down to your risk as well, what you're willing to risk, what and what your goals are. But certainly I think bonds do hold a place in people's portfolios.
Yeah, I can imagine that if I would be retired, I would be more thinking about bonds from that point of view.
Sergi has asked us, how much matters for you when you're willing to invest in US stocks and the EU USD pair currency rates are in the all-time lows?
Not really, because I use dollar cost averaging. But yeah, I do diversify across currencies. I think 50 to 60% from me is coming from the US. I think another 35% from the euro, and then some other currencies like the Swedish crown and such I have as well. So, but generally speaking, I just dollar cost average.
Cool. Anders has asked us, should you really care about total return as a dividend investor? To me, honestly, this depends on your goals, I would say. As a dividend investor, I'm more interested in income, but I do understand total return is what everybody judges against the market. But the way I look at it is, I'm investing in high quality businesses that have some sort of growth prospects that will grow the cash flow and dividends. And by that proxy, you would expect the share price to grow with it. So while I don't track total return, it is something that's nice to have, but I expect it to happen over time if my thesis is all right about the companies I invest in.
Yeah, same here. My goal is dividend growth, but as a result, I know that total return is also relatively good.
Yeah. Marek has asked us, do you like browsing quarterly reports? I mean, is it really a thing you have to do, or do you like to do it?
It's more that I like to do it. I think you do need to read the annual reports, at least the shareholder letter and the recent performance, and then go a little bit to the notes that they will show to understand like why certain numbers are as they are. On a quarterly basis, I would just say like for your top 10 holdings, read the first page maybe to see how the performance was if you quickly see something, because usually when something bad happened, it will also be on the first page because they will talk about adjustments or something like that. Because often in our portfolios, the top 10 covers 50% or something like that of the total value of your portfolio.
Yeah.
So I would look at it like that.
Yeah, I mean, I like browsing quarterly reports. Some companies are harder than others. We just said how hard Air Liquide were at reading, and some companies are really easy. But yeah, I mean, you don't have to do it. I mean, quarterly, yearly is fine. But sometimes just to keep your foot on the pulse and to really stay on top of the company, it's just nice to browse through 'em. And you don't have to spend hours and hours either. Just read the main headlines, read some of the footnotes. I think the footnotes are really important
Yeah.
because that will tell you things that maybe they don't want you to know, but they have to document.
Yeah.
And yeah, that's about it really. David has asked us, the Swedish krona is at all-time lows versus the euro, making it expensive to buy shares in European companies. How do you act in this situation?
Again, dollar cost averaging. I have the same with the Polish zloty, right? It also fluctuates when I want to buy euros or US dollars, and I just dollar cost average. I don't know. I don't have any other solution. I don't want to sit on cash because I don't know what the currency will do, whether it will be less or worth more in the next year. So I'm just doing dollar cost averaging. And a good example is the euro to US dollar. It was like on parity last year. Then it went to 110 or 111 and now dropped to 107 again. So you benefit from higher dividend income when the dollar went to parity. But it was more expensive to buy, and now it's a little bit different again. So I do the same with the Polish zloty to US dollar or the euro.
Cool. Dave S has asked us, do you think for the early accumulation phase, roughly about 10 years, you would build capital faster with a mixed portfolio of dividend ETFs? So 80% global dividend aristocrats versus 20% high dividend yield versus an individual stock strategy.
Yeah, well, the issue is here that in Europe we don't have good ETFs. So if you take an ETF of the dividend growers, it gives you like a 1 point something percent, yeah, plus a 0.3% total expense ratio or something like that. So in Europe you're just screwed. So yeah, I don't think that I would build capital faster based on a lot of dividend ETFs. Yeah, but that's my personal opinion. I mean, it's not based on benchmarking or something like that. It's just like how I look at it. Yeah.
Yeah, I mean, it's always when I see questions like this and you talk about a strategy and then flipping and changing your strategy within 10 years, I struggle to understand how you do that. I mean, if you're building capital faster, your goal is to build capital, and in 10 years' time, you see that's working. What would make you change that? I mean, if you're still building capital in 10 years, sure, you'll probably sit there and go, maybe I'll spend another 10 years building capital faster. And it's just all about your goals and how you align that. As you said, to your point, ETFs is something we struggle with over here in Europe. It does seem like a solid plan in terms of having a mixed ETF portfolio, but I just struggle when that changeover point would happen. I think if you're going to have a plan, stick with it for the long term.
Yeah, I know that in some countries, for instance, they have it's more favorable from a capital gains tax point of view versus an
of course,
dividend tax point of view. So I can sometimes imagine that you think like, you know what, I'll save up to my retirement value that I need. And then I said, I don't take the 4% rule, but I switch then to a portfolio of dividend stocks that then generates the yield for me.
Yeah, but that might have a tax complication of capital gains
but I understand the thinking. I understand the thinking. I just feel like I started with this. I'm now 9 years down the road. I probably need another 5 years or something like that. It's done me well. Yeah, and I'm glad that I chose that strategy from the beginning. So I think you can also take clues from investors that are already early retired as dividend growth investors and study them. What stood out for them? Why were they able to get to that point, and how? And what? And you will see. I tell you, all of them were really consistent and dedicated. And I think that's the most important to take from here.
Dividend.xe has talked about BRICS, which is this new competitor of the US dollar. So it involves Brazil, Russia, India, China, and South Africa. I know we mentioned them on the show. But his question is, are we continuing to invest with BRICS in mind? I know they are accepting new countries: Saudi Arabia, Iran, Ethiopia, Egypt, Argentina, and UAE. So is that going to affect how we invest in the future, and what will happen with the dollar?
Well, tell me a company in Argentina that has a strong dividend growth profile. And I mean, I don't know those countries, so no, I'm not considering it at all. China, for me, I have some Alibaba stock, but I don't trust the government enough there. India, Russia, I mean, we know what's happening with Russia. So these are not the countries where I think they are shining because of democracies and respect for the open and financial markets. Yeah. So for me, I'm not having that in mind when investing for the future. But think about Unilever, think about Starbucks. They are generating a lot of their earnings there. They can deal later with a currency if it's being introduced and such, and I will see the impact of that as a shareholder.
Yeah, the clue will be in large corporations. They will react far quicker than we will. I will say, and look, it looks like they are building a competitor to the US dollar, and it looks like they're pretty serious in doing so. How long that will take, what will happen, I honestly don't know. But as I said, if I study the companies usually give you clues, and you might see them transition into that currency, then it might be worth taking more of notice. But at the moment, I'm still thinking as the US is a safe haven.
Yeah, and I find it really hard to predict geopolitics. Yeah, as part of my investment, and we did a podcast about macro numbers and everything, and how much we actually tend to ignore them.
Kean Murphy has asked us, he said he doesn't have a huge knowledge behind energy stocks, and he remembers us saying in one of the last shows that they were currently at the highest point in the cycle, yet Shell has a PE ratio of just 6.15. Just wondering, what is the best ways to analyze them?
Well, I think a low PE is actually the how you say it, the perfect example of where the market is signaling that they think that the market is at the top, because they are how you say it, they're putting the future earnings into the expectations there, and that's why they are giving it a low multiple. Now, there's of course a lot of stuff going on there, talking about oil to $100 can happen. It might stay there a little bit for longer. But generally speaking, this is by far not, as soon as on CNBC, every day is in the news, like the oil, the oil barrel price is crashing. That's probably a good signal that we are nearing towards the bottom of a new cycle. You want to see this fear about, and every news item, also newspaper, should be about oil and how it's crashing. If you see that, then like, okay, do your homework and select one of the better managed companies with a strong balance sheet.
Mike has asked me which Irish companies are worthy of a closer look by dividend growth investors. And I'll give you four, Mike. Smurfit Kappa, which we spoke about on the show, ticker symbol SKG, they're a packaging company. I've also done a merger recently as well, which is worth checking out. Glanbia, ticker symbol GLB, and these are on the London Stock Exchange, by the way. Glanbia is a food processing company. I think it's the 5th largest cheese plants in the world, and has a solid growing dividend. And then CRH, which we've talked about before, and we have a stock card on them. And then this one is a really good dividend growth history, but a low yielder, which is the Kerry Group, and their ticker symbol is KYGA. I think all four of them are solid businesses, and definitely worth looking into. NB has asked us about Nike, when to buy. Also, the monetary policy in Poland. What is your thoughts?
Well, but when to buy Nike, that's hard to say, right? But not at $96. It should be lower for me. It is on my radar, but I still find it too expensive. So let's say like that. If it goes to the low 80s, high 70s, I will put more effort behind my understanding about what I want to pay.
Yeah. I think I remember being asked this question back in October last year when it was crashing at a similar pace, and it got to 80, if I remember, 85.
Yeah.
And we were saying about $70, and I don't think my target has changed. It's still around the $70 mark for them.
Yeah, and regarding the monetary policy in Poland, I don't keep myself too much up to date with it. There is so much right-wing and left-wing media here that it's hard for me to understand really what it is about, because they're just fighting all the time. It's like in America, Democrats versus Republicans. I'm so sick and tired of all these people hating each other effectively when it comes to politics. But when you're meeting each other in private life, everyone is really nice to each other. For me, I never understand this area of politics and friendship, right? And that's why when it comes to monetary policy, I don't think Poland has been doing so bad over the last decade. So I'm generally confident that this company is doing the right, that this country is doing the right things. But it's a bit of a mess here in politics.
Cool. Alec has asked us about Raytheon. Is its dip a huge opportunity or a trap?
So if you believe in the long-term capability of Raytheon to deliver high quality products, it might be an opportunity, because they're of course looking at the share price. It's at a 52 weeks low, and the selling was mainly triggered by the last press release when they released their earnings regarding their Pratt and Whitney engines. So there seems to be some issues there. But hey, the company yields now 3.11% in dividend yield. There's a payout ratio of around 45%, a dividend growth rate of 5.29, and dividend growth track record of, I believe, 29 years.
Yeah.
So I think it is a nice entry level for a company if you believe in the long-term prospects of the company. It has a chowder rule of 8.5%. It's not something that heavily excites me, but if you're into this, then you can consider.
Yeah, I know our good friend Ian Lopuk likes this company and has just released a video with 3 companies, and he speaks about this and a little bit more in depth around the negative commentary and what that means as well. So I don't follow this company a whole lot, but I would advise anyone to check out that video. It's quite good.
Yeah, they did a merger a few years ago with UTX, I believe, and which looks promising in general.
Hector has asked us about Inditex, ticker symbol ITX. Are they the best retailer in the world? The competition and sector has a lot of depth, and they have high net cash and high margins.
Well, they're the business behind Zara. I mean, I think it is one of the best retailers in the world. But they don't have a flawless and spotless dividend growth track record. So that's why I'm not interested. But I understand that from our listeners from the Iberic Island, Spain and Portugal, this is a really interesting business, because it's one of those businesses, I think, in Spain that you can be actually proud on. Because they have a lot of old industry, but this one is really a global powerhouse. But the company has not shown commitment to the dividends under times of recent stress, and that's a big red flag for me.
Yeah. And then last question of the day is from Anders, and he's asked us our view on snack companies such as JM, Smuckers, and Kellogg's.
Generally, I like that industry, I must say, but I own already PepsiCo, which is also with Lay's chips really big in there. But I think generally the snack industry, I mean, I think people are desperate for healthy snacks, but they don't want to give up their chips. So companies that focus on chips with maybe less fat, less salt, I think they will do well in the long run. So that show the healthy alternatives. I think in general this industry will probably grow in line with inflation rates and such. So it's more like the companies that are able to grow a bit of market share, have a strong brand, can hike their prices a bit more, will do well. And I've not studied GM, Smuckers, and Kellogg's enough to be able to judge that on the portfolio, but I can see it with Pepsi and the Lay's chips. They are becoming so expensive at the moment. So
cool. Okay, that's it. Thanks to everyone for all the questions. Thank you, European DJ, for carrying the show today. Talking is a bit of a struggle, but it was an interesting to do this business breakdown. It said it is a European powerhouse. We hear about that company a lot, and I hope our community has either learned something, or if there's anything we've missed, glaringly obvious, please let us know. That would help our own learning and our own knowledge. But again, thanks to everyone for listening, and we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.